Good morning, everyone. Good afternoon, rather. We've just hit 12 o'clock. Thank you all for joining us today. Today's session is being presented by Alan Shala from Chelsea Corporate, and he is going to be speaking to you about buying or selling a block management company and what you need to know. If you have any questions throughout the webinar, please submit them in the Q&A box, which is just at the bottom of your screen here. And we will try to get through as many as possible at the end of the presentation. The webinar is also being recorded today, so if anyone would like to watch it back or share it with any colleagues or friends, it will also be available to watch back on the News on the Block YouTube channel. That is all from me. I am now going to hand you over to Alan to begin the webinar.
Rika, thank you very much indeed. It's a
You're
pleasure to be
welcome. Mhm.
here. Thank you so much for the invitation. I'm really delighted to share with you briefly a quick summary of the block management businesses overall and what are the key driving factors, but also if there are buyers or sellers of businesses on this webinar who are looking at perhaps at property management businesses too. I'm more than happy to take a few questions on that, and we can have separate conversations. So, as Vicky mentioned, my name is Alan Shala. I have the corporate acquisitions here at Chelsea Corporate. I've been with the company for almost 8 years. We are pure buy-side M&A advisory firm, so we help buyers of businesses with identifying opportunities which are typically off market, and we provide that unlimited support on deals all the way through to completion. My background is in investment banking. I started my professional career covering pan-European equities in various sectors, but predominantly focus on IT, telecommunications, manufacturing businesses, pharmaceuticals, and medical devices. So today we will be looking at buying or selling a block management company, what you need to know. Of course, these slides will be available to you. Of course, as Vicky mentioned, the webinar is being recorded, so we'll be more than happy to send this to you afterwards. So in today's webinar, in today's workshop, we'll look at why block management is attracting buyers, what is the current market activity, what drives value, what are the key risks associated with the whole process. How do you prepare if you're a seller, a potential seller, what you need to do to prepare for a business sale? And also crucially, I know a lot of people will ask about this and have a keen interest on this. What are the deal structures and typical valuations in this space? So how to maximize value, how to avoid the typical pitfalls, and how to successfully complete a transaction. First of all, let's address why block management companies are in demand today. Well, if you're running a block management business, and of course there is a difference between block management and property management, but let's focus for a moment on the block management. And if you're running those, you will know very well that these businesses, these companies have recurring revenues. More often than not, they tend to have long-standing client relationships, and also the cash flow is fairly steady and strong cash flow generation. The reason cash flow is very important is because if you're a buyer of companies in this space, then lenders love strong cash flow generation. But also, the market is very fragmented. So there are a lot of companies out there which are attractive to those who are looking to consolidate this sector. There are in many instances some cross-selling opportunities, but also the inflation-linked fee increases, which means that the cash flow remains steady and growing for these businesses. So these are some of the key attractions really to buyers in this space. If you look at the last few years, and of course, there are many experts who operate in this space, the growth, some of the market drivers have been obviously driven by the growth in leasehold properties, but also increases to the compliance requirements. There's also inevitably that growth for or demand for outsourced management of these businesses. And I mentioned earlier, what is driving the consolidation is usually the larger players, really larger operators, who are very interested in this space. Now, understanding the block management business, if you're new to this industry, is really, really important. Those of you who have been operating in this space for a long, long time will obviously have a clear understanding of where the typical revenue streams are. So obviously, it's the management fees, is the secretarial services, insurance commissions, also project management fees in some instances, and further down that list, if you like, major works administration, obviously ground rent and compliance services. But the vast majority of revenues, as you know, come from the management fees. And I think the key really here is when it comes to consolidation in this sector, how can you grow the other elements of the potential revenue streams rather than just relying predominantly on the management fees or insurance commissions? So from the buyer's perspective, what you have is management contracts. Reputation is really, really important. I must stress this because sometimes the businesses who operate in this industry, in my view, unfairly get criticized. So reputation is really important. The caliber of the management team, second tier management team, the staff, systems, client relationships, but also accreditations are key and really the main assets in this space. So please, I just wanted to remind everybody, please feel free to ask any questions that you have, and obviously we'll get to them at the end of the session. Anything that we can't answer today, I'll be more than happy to follow up with you after the webinar later on today or this week. So if you're a buyer, and we are working with a number of buyers in this space, these are the key things really that they are looking for. So strategic buyers tend to look for companies for businesses that operate in this space that have that ability or can show that they have increased revenue through additional units under management. But also there is that potential for geographic expansion. Also, increase in recurring income is really important. So as I mentioned, their ability of these companies to increase revenue from other sources. Typically, when buyers acquire companies, particularly in this space, they'll be looking for a lot of synergies. They will be looking at ways to cut costs because mergers usually lead to that. So you'd be looking for low-hanging fruit, as it were, where you improve margins, almost immediately as part of that process of acquiring a company. But also, as I mentioned earlier, cross-selling opportunities are really, really important, and also talent acquisition. Financial buyers look for predictable cash flows. The larger the cash flows are, the better it is. Ideally, you want to have a company, a business that is generating more than 500,000, at least 500,000 of EBITDA or free cash flow, because lenders get excited about that. You're much more likely to get credit lines if that is the case. So the higher, the better. But also growth opportunities. Where are the growth opportunities within that sort of company, and can we scale that business? And also strong retention rates are absolutely crucial. By the way, banks, lenders overall will look at these four factors very, very closely, because it will determine the loans that are available to buyers that operate in this space. So let's look at it from industry perspective. Let's look at it from buyer's perspective, but also from seller's perspective as well. When it comes to valuation. So what are the key drivers of valuations? Why certain businesses who operate in this space are more profitable than others, and also they demand higher valuation. So the number of units is very, very important. As I mentioned, the higher the recurring revenue, the better and the more attractive the company is. You're asking, I'm sure, what percentage of recurring revenue is ideal? Obviously, the more the better. But certainly, I would suggest 60% plus. So 60, 70%, 80%, in some cases, that would be very, very welcome from lenders in this space, but also buyers in the block management space. The rates obviously related to the contract retention. What is the client concentration? So client concentration is really another very important aspect of when it comes to the valuation. Low concentration rates are better if you're relying predominantly on two or three key clients and they make, let's say, for argument's sake, more than 50% of your revenue, then that is a risk. You may very well have long-standing relationships with those clients, but still, if you're a buyer in this space, they will feel slight unease if the concentration is too much focused on a handful of clients. Profitability, of course, generally, you will know that in this space, we are looking at high single digits to mid double digits in terms of margins. So the higher you are towards that range, that scale, the more valuable the business is. Quality of staff, I mean, the experience, I would say, is really, really important. The caliber of the team is crucial. Sellers will eventually leave the business, so the buyer will be left essentially with the strong second-tier management team in place, who have strong relationships with the clients and making sure that the staff is long-standing, have been with the company obviously for a number of years, is really important. Inevitably today, technology is being introduced across the board. Strong compliance record is very, very important. And of course, growth trends. How the business has been performing over the past few years will give that, that comfort to buyers that this is a growing company, it's a growing business, and it's something that has to deliver when it comes to, few years under the new acquire, if you like, leadership. So just to recap, the biggest value drivers when it comes to this space are units under management, key metric really that buyers tend to look at, contract security, of course. I think long-term client relationships are absolutely crucial, and they will inevitably demand higher multiples. Third element is high retention rates, and also team strengths, as I mentioned, but also any introduction of the technologies, so CRM systems, accounting system, compliance, software, automation, and so on and so forth, is, I would argue, the fifth driver of valuations. Excellent. Welcome to those of you who've joined us in the past few minutes. Please feel free to share your thoughts, your comments, questions that you have for us, and we'll come back to you later towards the end of this presentation. And of course, we will be more than happy to, and we will follow up with all of you who attended this webinar, who is attending this webinar today. So from buyer's perspective, when it comes to assessing these businesses, these companies, they look at a number of things, investigate a number of things. Compliance is very important, as you can imagine, especially in the process when, given what has happened in the last few years. So Building Safety Act obligations, client money handling, also AML procedures, insurance compliance, and so on and so forth. So these are from the compliance perspective. From the financial perspective, there are a few things to take into account. Of course, revenue concentration, decline in portfolio. If there is that element of revenues having dropped in the last few years, you will lose that valuation. Unfortunately, there will be a discount to the valuation assigned by buyers or businesses. Of course, you don't want to have any outstanding disputes, so please have everything in order, have everything in place. Debt levels, of course, the lower, the better. From an operational perspective, a summary, key personal dependency in any business, in any company, is a risk for buyers. The the less your business is reliant on you, the better it is. And I think we will come to the point shortly in the next few slides in terms of how sellers can prepare their company for sale. But high staff turnover, key person dependency, poor documentation, and also reporting systems not being up to scratch are some of the key risks that buyers will look at from compliance, financial, and operational. These are the key things really to look out for. So I'm hoping there are a few attendees today who perhaps are looking to sell their block management business, their block management company. So what you should be looking for before going to market. You might even be approached by buyers today or the next few days, maybe after this webinar. Who knows? But having certain things in place before you get ready to, or you sell ultimately, is really important. It's going to work in your favor. So as I mentioned, make sure that the business is not wholly reliant on you. And also make sure that the management team has the strength and the depth to run the business comfortably without your presence. And it's very difficult for us to let go completely of things on day-to-day basis. Most owners love to micromanage, not necessarily micromanage, but to be certainly involved in how the business is run. So, to have that strength and depth in management team is really, really important. It's going to work in your favor. Oftentimes, especially when it comes to off-market opportunities in any sector, the reporting is not necessarily to the standard that buyers like to see. So make sure that you've got that in place and you're able to pull out information at a moment's notice. So having everything in place is really important. And obviously with the accounts, I referred earlier to any potential disputes. Very important that those are resolved so you have a clean bill of health from that perspective. And, to have, processes documented is also very, very important. So buyers effectively will be moving into that business as it were, acquire that from you with pretty much a turnkey operation. I think probably that's the best way I can put it. So these are some of the key things that I'd be looking for if I was a seller of a business, and what buyers would like to see in your company. As a result of all of that, you will end up most likely with a higher valuation. You will have probably more buyers interested in your business, faster transaction. Due diligence will be done much, much quicker. And you will not have any issues there because everything is ready, everything is prepared. And this, as a result, you will not only have higher valuation, but all the costs associated with the due diligence process and everything related to the sale of that business will be minimized as well. So preparation is really, really key here. Okay. Actually, I would like to discuss a little bit about actually, before we do that, we'll come to how the deals are structured and why you're getting certain offers, or why buyers are making certain offers for businesses. So let's recap a little bit about what we are seeing today as far as the market is concerned. First of all, what is really obvious is that these businesses are very attractive. Buyers love them. I don't think you'd be surprised at all. And they are in demand. It's very similar to what you see with accountancy practices. Everyone wants to own one, and sellers hold on to them very, very strongly. And usually you end up with somebody who is retiring, essentially. And there are very similar, very many similarities in that because of the high recurring revenue, as I mentioned. They're not perhaps as high as in accountancy practices space, of course, but I think you get the point. So what we are seeing is increasing consolidation. There is more trade buyers that are entering the market. But also, we are also seeing growing PE interest in this space, especially in the last couple of years or so. Um, I mentioned the geographical expansion. Lots of buyers would be looking to move in other areas within the UK, or maybe even further afield. But certainly, there is that demand for regional operators. Recurring revenues obviously are key element here, but also since Grenfell, of course, and other elements that we've seen as far as the cladding is concerned, there is that scrutiny around compliance, which we it's unavoidable. So as far as the buyer sentiment is concerned, well-run businesses are highly sought after. Now, this is an important bit that I really wanted to share with you, and I know that there'll be a lot of questions from both buyers and sellers, or anyone who operates in this space, or maybe people who just have an interest in this space about valuations and typical deal structures. So, typical components when it comes to this space, like with any other transaction that happens out there in the SME market, so private businesses that we help our clients acquire across sectors, is that usually you tend to have typically an initial consideration, a deferred consideration, earn-out, vendor support period, and also restrictive covenants. So what is that initial consideration? So typically, today we are helping our clients defer anything between 20, 30, up to 40% of the value of the business, which means that you have around anything between 50 to 60, 70% paid on completion. So it really depends. Deals are very much unique. Every transaction has something specific about them. This is just a guide, really, that you should take away from this. Earnouts are important because, from the buyer's perspective, they want to. It's all about risk minimization here. From the seller's perspective, it's understandable that they would want as much as possible on completion of the deal, but buyers also, need to make sure that a portion of that deferred consideration over a period of time, whether it's 1 year, 2 years, 3 years, whatever the case may be, that the company and the business that they acquire continues to perform well. Why structure matters? Well, I think the structure is really, really important, I would say, more important than the price. From buyer's perspective, they want to make sure that it works for them. Highest offer is not necessarily the best offer. The highest valuation that you may get, from a buyer, if you're a seller, they may not necessarily be the best out there. It's the ability of the buyer to obviously deliver as far as the funding is concerned. Also, it's worth mentioning here that every transaction really rests on the strength of a relationship with the seller. And the stronger that relationship is, I mean, ultimately, you would have heard this many, many times. People buy from people. So that chemistry between the buyer and the seller is really, really important. But the deal structure is absolutely crucial. The payment, do the payment terms work, and so on and so forth. So certainty and deal terms, I would say, outweigh the headline price more often than not. Okay, I think it would be wrong not to mention finally why deals fail. There are some common denominators across sectors, by the way, not necessarily just in this space, but whether it's a manufacturing business and IT services and so on and so forth. But there are some specifics related to this sector. So why deal fails? Well, valuation expectations. I think there are many ways you can make sure that the deal doesn't fall because of the valuation. Because remember, at the heads of terms, the price is agreed subject to contract and due diligence process. If there are any elements that come out of the due diligence process that may affect the price. Have an advisor that works for you if you're a buyer. Then you want to make sure that you deal with it and you find a solution. If there's a drop, for argument's sake, in turnover by 15, 20%, in those kind of situations, you got to approach the seller and have a conversation, honest conversation about that, and come up with a valuation that reflects that new information that has come out of the due diligence process or happens during the due diligence process. So really, there are solutions to these situations. Poor preparation, compliance issues, as I mentioned, compliance is not a small matter in this space. So you want to make sure that you're open, you're transparent, you build that goodwill between yourselves, so buyer and seller, during that process, and you're very open, very transparent. Again, before you get to the point of signing the heads of terms, you will have a good idea about the customer concentration. If that changes again during the due diligence process and it's new information, let's say for argument's sake, again, there are ways to deal with it by adjusting the valuation downwards if that were the case. Again, deals fall if there is something that changes in the depth of the management. If people leave, for example, that changes and makes buyers nervous. Also, you've got to make sure that you really, again, I must stress this, that you build a strong relationship with the buyer. So the buyer and seller relationship is really, really important. If documentation, for example, is requested from your lawyer, you've got to make sure that those responses and that information is provided to avoid the possibility of the deal failing. And again, we see this in many, many other sectors. When the strength of the relationship, and I mentioned this a few times now, is strong between the buyer and the seller. By the time you get to the heads of terms, typically more than 70% of the work is done, and also there is that desire from both parties to get that deal over the line. Also, as is often the case, repeated many, many times, time kills deals. It's very important that you keep that momentum going. You've got to really push lawyers and accountants to do their work and to keep them on their toes, because if the momentum is lost, both parties have invested in this. They spend money on lawyers and on accountants and fees with brokers, etc., etc. You can't lose that momentum. You've got to make sure that the deal is done. Okay, so I'll summarize quickly and we'll hand over to Vicky very, very shortly for any questions that you may have. I welcome your thoughts and your comments. So in summary, for those who are looking to sell in this space, prepare early, focus on recurring income, reduce dependency on you as the owner, have the latest systems in place, and create that competition if you can. If you're a buyer of the businesses in this space, focus, I would say, on quality, not just size and price of the business. Investigate retention and customer base, customer concentration, understand any compliance obligations, especially if you are new to this space, and also, especially if you are new to this space, plan that integration very, very carefully. Make sure that you know exactly what to do, completion plus day one. So these are really some of the key things. And I'll be very, very happy to expand much further on all of these with all of you who obviously attended our webinar today. Very briefly, in a couple of minutes, I'd like to give you some idea about who Chelsea Corporate is and what we do. So we are a pure buy-side M&A advisory firm. We are based in London, in the city. We've been around for more than 14 years. As I mentioned earlier, I've been with the company for coming up to 9 years now. So we help buyers with acquiring businesses here in the UK, but also internationally. In fact, more than 50% of our client base today is outside the UK, and they are looking to acquire, and we're helping them acquire businesses in the UK, but also internationally. We have a tried and tested process. which works incredibly well for our clients. But crucially, there is no conflict of interest whatsoever between us and our clients. We work with private equity firms, entrepreneurs, trade buyers, but also listed businesses. This is a quick summary of how we help our clients identify businesses. So the first thing that we do is we assign you a dedicated deal team, which comprises of corporate deal leader, I should say, deal origination team, and every transaction is director led. We will spend time to understand your requirements in detail. We will send you a document which contains all those details of what makes an ideal target for you. Our origination is very, very strong today. There is 25 of us here at Chelsea Corporate. More than half are focused entirely on deal origination. We have invested heavily in all sorts of databases, but also more recently in AI-powered CRM systems, which I have to say have been a game changer for our clients. Today, as a result of that, the vast majority of deals that our clients complete, 9 out of 10, for example, last year, we sourced ourselves. So that targeted search for opportunities is really, really important. Once we find targets, we will make those introductions. We will share all the information that we have. We set up calls between the buyer and the seller. We believe in that incredibly here at Chelsea Corporate because it really sets the tone. You meeting with the seller and buyers, obviously meeting with the seller. It's very, very important for both parties because it will set the tone about how the deal is likely to progress and whether it will come to a transaction. Also, we make sure that the qualification is very rigorous so that every introduction matches your brief and gives you the best chance possible to progress further during the process. Afterwards, we'll discuss deal structures. The discussions here rest on how to minimize the risk, what kind of offers we are making, why we are making those offers, and also providing some comparable evidence of deals done in the space, because that level of comparable evidence in the space brings parties together and ensures that the deals are done. Also, by the way, we work very closely with lenders. So we have access to lenders, we have access to lawyers and accountants. So when that is required during that process, a little bit later in the process, we are able to provide you access to those professionals. Then we will make an offer. We will make an offer that is likely to be accepted, but also, as we mentioned earlier, has a payment structure that works. And also it is adaptable and passes the scrutiny of the due diligence process. Inevitably, there'll be some negotiations before the heads of terms are signed. So we help our clients to negotiate the best deal possible and obviously document that in the heads of terms agreement. Then we run the due diligence process. We work very closely with both parties, lawyers and accountants, and run that process. As I mentioned earlier, you don't want to lose momentum here. We want to make sure that we get across the line as quickly as possible. But it's really important, I must stress this, it's very important that you build a strong relationship with both parties, the buyer with the seller and vice versa, because that goodwill generated throughout the process from that very first meeting and call will ensure that the deal will get done. But as I mentioned, things will come sometimes out of the due diligence process. So it's very important that that advisors deal with those and make sure that the deal completes on time. And that's really that 1 to 10 kind of step that we apply, which has been incredibly successful for our clients for more than 13 and a half years now. I just wanted to leave you with this very briefly. We run regular webinars here at Chelsea Corporate once a month, whereby we discuss all aspects related to M&A, sector-specific valuations, deal structures, how to find opportunities, of market, and much, much, much more. We've been doing this for a long, long time. And on the 29th of July, at 12:30 p.m., we will be discussing buy side versus sell side. So why and who represents you basically matters during this process. Okay, right. We reached the end of this. Thank you so much for your attention and for being kind throughout this presentation. And Vicky, here we are.
Hi,
Back to
thanks,
you.
Alan. That was great. We do have a couple of questions here. So the first one I think was from sort of the earlier part of the webinar.
Yes.
Someone was asking, how do you measure the quantum of the value drivers?
Okay. Let's get to values. I mean, maybe we can sit on this.
Yeah.
We can have a look at this slide here because it's the bit really that talks about evaluation. If we move away from slightly, let's say, from what we discussed predominantly today, the key thing really when it comes to the valuation of any business is um, is that recurring revenue element. How much of your revenue is repeat business? Because if you have to go out there and constantly win contracts, win revenue, it will be driven by your sales force and so on. The more of recurring revenue you have, I would say the better the valuation of your business is. So let's say, for argument's sake, you're looking at two companies. One has a recurring revenue of 70% and the other one has a recurring revenue of 40%. I would argue that, of course, the other elements that we have here on the screen are really important too. But ultimately, recurring revenue and profitability of the company are the main drivers. And if someone has recurring revenue of 70% and has margins of, let's say, double digits, mid double digits, as I was suggesting earlier, or maybe even more than that. And then you look at another company that has, let's say, 40% recurring revenue and margins are 8% or 10% for that matter, depending on the profitability, whether it is 500,000 or more than that, or whatever the case may be, the first business, the first company is much more likely to demand a higher valuation. And that is going to be, in some cases, depending on how large it is, anything from 5 times plus the profitability of the company. So it's got to be recurring revenue. It has to be the margins that you're making, and of course, the other elements will be important too.
Okay, thank you. I hope that answers your question. Um, there was another question here, but it was followed up with, I think you've answered it in your debrief at the end. So it was someone just saying that they are potentially looking to sell. Do you put the buyers and sellers together to facilitate the deal, which you've said that you do? And do you help sellers get ready for a sale before the match to make the business as sort of attractive as possible?
Very, very, very good question. Thank you so much for asking that question rather. We are buy side, of course, as I mentioned, so we act on behalf of buyers, but especially when it comes to off-market sellers that are not represented during this process, we work very closely with them to explain, for example, what
Mhm.
sort of things are needed, and why we are making offers that we are making, why we are proposing certain deal structures, and so on and so forth. Ultimately, although it's our clients that pay our fees, our buyers that pay our fees, um, success is driven by both parties doing a deal, right?
Yeah.
So we got to make sure that you're comfortable, that both parties are really comfortable during this process. We are in constant contact with our client, which is our primary responsibility, but also it's very important that we have a strong relationship with the seller because there is no deal if there is no seller there. But just to conclude on this, absolutely, we would be happy to have a conversation. We have clients that are looking at this space, as I was referring to earlier. So we'll make sure that we'll be in touch with you after the webinar.
Okay,
But very
thank
good question. Thank you very much.
you. Okay, someone has asked, I'm curious how you think about the trade-off between the near-term synergy value and the long-term retention risk, especially in block management where service quality and trust seem so tied to keeping clients after a deal closes.
Yeah, again, really, really excellent question. I I would say the quality of the contracts is really, really important.
Mm,
It's absolutely key here. Buyers in this space will certainly look at from buyer's perspective, there might be many considerations why they are looking to obviously buy in this space. And ultimately, they want to fill a gap in terms of geographical location, for example. There might be certain services that a block management company provides that they don't. As I mentioned, quite a lot of turnover is associated with fees, but if there's more diversity to to the revenue, to the turnover that they're achieving, the more attractive the business is going to be.
mm,
Initially, I think buyers will be looking at where the growth, as I say, is going to come from, but also where can they achieve those immediate synergies between the two, maybe cost cutting, whatever the case may be. I think I think if I understood the question correctly, longer term, if you are a seller, you got to really explain, I suppose, the strength of the business, why the business is
yeah.
likely to continue to do well after they sell. There might be, as I mentioned earlier, that transition period. More likely than not, you will be part of that acquisition for a period of time to help the buyers, obviously bed in, as it were, and also it's important, especially for you as a seller, to have that strong relationship and make sure that day one or day 30 or or a couple of years later, whatever the deferred consideration thing is structured, that the business does well, because part of of consideration, the payment due to you, will be more often than not linked to the performance of the business. But please, happy to pick this up after the webinar, or if there isn't a follow-on question, I'm happy to take that.
Okay. There's quite a lot more questions there, so we'll see how many we can quickly get through. Someone has asked what consideration is given to future pipeline post deal, and quality of customers, for example, developers.
Absolutely crucial. Another beautiful question. Thank you so much for asking that. Um, the only thing that I would say with that is, if you truly believe that the potential is there from your perspective, then um, I think you one way to look at it is that buyers base the valuation and how much they're going to pay for your business
Mm,
on the recent performance. But you can also, the earnout that's when the earnout comes in. So, for example, if you want a higher, or if you ideally want a higher valuation for your business, but the seller somewhat is more risk averse, and we can't quite convince them that they should pay you a premium because there is a potential uptick to the performance and the value of your business. I think then we can structure it in such a way that you benefit from the new contracts, let's say, that they are going to come in the next 6 months, 12 months, whatever. So you will get that upside. And that's my point. You need to structure the deal in such a way that you benefit from that potential upside.
okay, thank you. Um, Someone's asked over how many years financial accounts would a buyer look at?
Ooh, great question. Great question. Great questions, by the way. Loving this, guys. Loving it. I think, um, look, you don't want to go back too far back, right? You don't want to go back 7 years, 8 years, 8 years, and so on. Not need. There's no need for that. I would certainly suggest that you have accounts ready, available to you for, anything between 3 to 5 years. The reason I say this is because, especially if you are concerned about people not assessing the strength of your business and what you've done. If you started it, let's say, for argument's sake, from scratch, then I think it's only right that you show what you've done with it, the growth
Yeah,
that you've achieved. Certainly 3 to 5 years.
okay, that's good. Someone asked, I mean, this might be more of a one-on-one conversation, but what are the typical level of fees?
That's a great question, Vicky. And generally, my view is that you should charge as much as possible. No, no, of course not. But I should mention that it's our buyers that pay our fees, and I'll be very happy to discuss how we work in detail with our clients. But there is an element of first of all, the clients that we take on, they meet minimum requirements in terms of the proof of funds. By the way, this is an important point because there might be one or two sellers who've joined us here today. Because we work for buyers, we do the AML checks, we do the ID checks, and our clients show us proof of funds. So anyone that works with Chelsea Corporate, whether it is an off-market seller that we've approached, or indeed a sell-side advisor, they are very happy to work with Chelsea Corporate because they know we've taken on a client
Yeah.
who has gone through the checks that we've run. And look, from our perspective, our clients do pay us a monthly retainer and success fee on deal completion, but I think it's fair to say that we only make money if our client is successful. So your success is linked very much with our success. But as I say, I'm very happy to pick up this conversation off air.
Um, Someone's asked how large or small the business that you represent.
Ooh, good question. Typically, so we are obviously sector agnostic, so we cover every sector that you can think of. In terms of the deal sizes that we've done over the past, let's say, couple of years, they range between, in terms of valuation, that is,
Hmm.
right, 1 million all the way to 50 million. So really anything less than 1 million, we don't necessarily do. So the valuation range of businesses and clients that we've helped over the past couple of years have been between 1 to 40 million plus.
Okay. Okay. Someone's asked if you were looking to agree a vendor transition period but
Yeah,
not transfer any staff,
yeah.
um, does that make it more or less attractive?
I would say less. I would say less attractive.
Yeah. Um, we've got one or two more left. Um, Someone asked, what is the broad brush way that you would that you wait, what is the broad brush way you do evaluation? How many times revenue or repeat business via profit?
Yeah, good question. Very, very good question. You can take, I would say, you can make it very, very simple, um, which is um, which is the profitability of the business. So you can look, for
Hmm.
example, at free cash flows. You can look at the actual net profit of the business and base it off that. The at the lower end, let's say around 500,000. Let's pick a number,
Yeah.
around 500,000 in terms of net profit. I would like to use net profit, which means that we paid everybody, even the government, and this is what we have.
Hmm.
Even ourselves, we paid ourselves a net profit. Then I would say between 3 to 4.5 times. As we get higher in terms of profitability, then you're looking at even 7 times. So the more profitable you are, the better, of course, it is. I think the multiple that buyers will pay for your business then will be related to, associated with what we are mentioning here, which is the quality of the contracts, the quality of I don't want to use this word, the quality of staff. I think it's so unfair, isn't it? Everybody's is amazing in every business. I sincerely mean this, but I think you get my point, right?
Yeah.
The depth of the team and how long they've been with the business is crucial because it gives us the comfort that look,
Hmm.
these guys have been around the block and so on. I hope that answers your question, but I think that would be the average. That would be the broad brush, I would say. And by the way, whether you use the turnover or you use the net profit, you're going to end up with the same metric, if you like,
Yeah.
in terms of valuation. But I like to use the net profit because it's probably the cleanest thing that you can use. But
Hmm.
be mindful of the fact that that there might be all sorts of ways that owners of businesses minimize the costs or the tax, let's say, considerations. So you want to make sure that they actually pay themselves a market rate because then we need to do adjustments there. Otherwise, the reflection of the multiple it would not be correct.
Okay, thank you. I think that was actually the last question because I've
Was it?
just noticed the one that here is a repeat of a question that we've already covered.
Yeah.
Um, okay, that's brilliant. Thank you so much, Alan. That was really interesting.
Thank you
Um,
very much.
Thank you to everyone who joined us today. As I mentioned, the webinar will be available to watch back or share via the News on the Block YouTube. And as Alan mentioned, they do have another webinar coming up next week. Alan, did you want to give details on where people can register for that webinar?
Yes, the best way to do this really is to go to chelseacorporate.com. Or we have our details here, so feel free to call us on this number. But the best way to do it is to go to chelseacorporate.com, and then we have a section on webinars. I just want to thank you again, Vicky, for inviting me along to this. I really enjoyed it. Great interaction with each and every one of you, and especially those of you who asked questions. So I look forward to speaking with you after the webinar. I'll be in touch just to get to understand a little bit more about you and what you're looking to do, whether you're looking to buy or sell or just have an interest in this space. And yeah, I look forward to speaking with you over the next few days.
Thank you, Alan. I'll be in touch with a copy of the slides and the recording for anyone that would like it. Otherwise, thank you for joining us, and I will see you on the next one. I hope you have a good
Thank you,
day.
everybody. Thank you. Have a
Thank
great rest
you.
of the week. Bye bye. Bye
You
bye.
too.
Thanks.
Bye.
Bye. Bye.